Underwhelming Tesla and Google earnings wreaked havoc across the equity markets yesterday, sending Nasdaq 100 more than 3% down in the session. Even the small caps gave in to the pressure at yesterday's trading session despite a steepening US yield curve. So some say that the Federal Reserve should think of cutting its interest rates as early as at next week's meeting. But a strong US growth data due today could easily suffocate that idea. So welcome, this is Swissquote's Daily Market Talk. So the underwhelming results from Tesla and Alphabet earlier this week painted the equity markets in the red. The S&P 500 experienced its worst sell-off since December 2022 with a 2.30% drop during the session. It tested its 50-day moving average that stands near the 54.28 level to the downside, while Nasdaq 100 tumbled 3.65%, erased $1 trillion and sank below its own 50-day moving average. And Tesla dived more than 12% on earnings miss and no fresh news on robotaxis. Google lost 5% on prospects of increased AI spending. And we are talking about big numbers here, guys, because Google's capex spending will reach or exceed $24 billion for the rest of the year. That will bring the total spending this year to almost $50 billion or around 84% more than the past 5-year average, according to the Wall Street Journal. So the company CEO thinks that, under-investing in AI is a bigger risk than over-investing. But that narrative is no longer welcome or popular among investors in AI. And that prospect of, AI spending, which should have normally been an outright positive for stocks like Nvidia, for example, didn't enchant investors there either for once, because Nvidia saw its stock price dive 6.80% yesterday. Broadcom fell more than 7.5% as AMD sank 6% below its 200-day moving average. Now, this harsh market reaction to Google earnings, which were beat, by the way, hints that we are coming to a point in the AI rally where investors are increasingly impatient to see the massive spending from big spenders turn into profits, while the big AI spenders continue to say that, they should just spend more before seeing the benefits of their AI investment. So it's a hard place to be both for investors and the companies right now. As such, Meta, which could also tell its own investors that more AI spending is in store, also fell more than 5% at yesterday's trading session. So all in all, Roundhill's Magnificent 7 ETF dropped more than 6% yesterday, slipped and closed the session below its 50-day moving average. For the bears who were waiting in ambush, the time of correction in AI rally may have come and could erase 10 to 15% from the S&P 500 if the upcoming earnings from other big technology companies can't turn the wind soon enough. Also note that from a broader perspective, the fact that the Federal Reserve cut expectations are rising right now is not positive for the big technology stocks, as these technology behemoths were seen as a safe place to hide for investors when the interest rates were high, and should see their advance at jeopardy due to potential sector rotation to non-technology pockets of the market. Therefore, a technology sell-off combined with lower interest rates is expected to boost the small caps and also the dullest pockets of the market, like boring stuff like consumer staples, healthcare, and utilities. But yesterday, the winning combo of technology outflows and lower yields in the US couldn't cheer up the Russell 2000 index, which closed the day 2% lower. Yet note that the US yield curve got steeper yesterday as the 2-year yield fell below the 4.45% level for the very first time since February this year, while the US 10-year yield took the opposite direction and rose to 4.30% mark, narrowing narrowing the gap between the two yields to just 15 basis points, which is the smallest gap since October 2023. So that's a confirmation that investors see the Federal Reserve lowering its interest rates sooner and probably more rapidly than previously expected. The consensus right now is 2 or maybe 3 interest rate cuts this year, with the first one seen coming in September, but the odds for an earlier interest rate cut next week, for example, are on the rise since the former New York Fed head Bill Dudley called for lower interest rates, preferably at next week's FOMC meeting. So activity on Fed funds futures assess less than 7% chance for a hurried rate cut next week from the Fed. And because the Federal Reserve has no reason whatsoever to rush to the exit in the absence of a reason to do so, a reason like a bank stress, for example, or abnormally soft economic data, I think that we will still, wait for the September meeting to see the Federal Reserve cut its interest rates for the very first time this year. But that's just me. But on the other hand, the Fed doesn't really surprise much. But the fact that the Fed and the market is actually preparing to, cut the rates should keep the US dollar index under pressure for a while. Although note that the rising Fed cut bets also softens the dovish central bank expectations elsewhere in the world, and that should limit the potential weakness of the greenback from the actual levels. Now, the US dollar index fell below its 200-day moving average level yet again yesterday. And due today, the latest US GDP update is expected to, show that the US economy may have secured a 2% growth in the second quarter of this year, up from 1.4% printed the quarter earlier. And relatively strong growth from the US could actually limit losses in the US dollar as economic woes rise elsewhere. And in this context, the euro dollar extended its losses to 108.25 level yesterday after a set of weaker than expected PMI numbers from the Eurozone countries fueled the expectation that the European Central Bank won't have a choice but to cut its own rates in September yet again. The weakness in the German economy, where the composite PMI actually sank unexpectedly into the contraction zone for the very first time since April earlier this year, and a further slowdown in the French manufacturing numbers stood out at yesterday's release. So we also know that the Chinese slowdown story is not helping the European luxury stuff makers at all. In this context, LVMH was the latest big company to take a hit yesterday with a 5% sell-off as sales in China fell about 14% last quarter. And elsewhere, Deutsche Bank in Germany posted first quarterly loss since 2020 and scrapped its second share buyback plan, which actually led to an almost 10% plunge in its stock price after the earnings yesterday. Now, coming back to the overall picture and to the FX, France should eventually see the benefits of the Summer Olympics, which are about to start in France in Paris as soon as tomorrow. But besides that temporary relief that we might see, the weakness in the European economies will certainly lead to further interest rate cuts from the European Central Bank as well. And therefore, the rising dovish European Central Bank expectations defy the rising dovish Fed expectations, because the US economy is just simply stronger and could eventually prevent the Eurodollar from making that move above the 110 psychological mark in the coming weeks. And speaking of interest rate cuts and central banks, the Bank of Canada cut its policy rate by 25 basis points to 4.5% yesterday, as expected, and highlighted the downside risk to the economy that fueled the BOC dose yesterday and sent the US dollar CAD past the 1.38 level as predicted. And elsewhere, the long Japanese yen trade is gaining momentum. The dollar yen fell to 152.23 level on the back of rising BOJ rate hike bets and the unwinding carry positions as a result of it. Now, the major risk that I see here is that the BOJ comes up next week and says that, there is no rate hike, guys. Just there is nothing to see here. And bada boom, the whole long Japanese yen trade collapses. But that's just probably a bad thought and nothing more. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please don't hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates and subscribe to our YouTube channel for daily market comments. And of course, please don't forget to hit the like button to let us know that you enjoy these videos. So I will meet you again tomorrow. And until then, good day trading.